Good evening, everyone. This is Gavin Martin here from Cornerstone Wealth. Thanks so much for joining us. Welcome to the session. It's Centrelink and the Age Pension session. Ross, I think you're online. G'day.
G'day, Gavin. How are you?
Yeah, well, thanks. So I'm not sure if you have any other Christian Super news. I was excited to see the new investment options online this month.
Yeah, look, correct. There's been a number of, it's been a big few months for us, both in terms of the restructuring of our fees, which was announced back in June, effectively sees, in real terms, every member in the fund actually paying less fees, and hopefully the restructuring of fees also enabling increased transparency and simplicity. The fee structuring is always complex in super, so we're really pleased to see those changes go live. But equally, as you say, the formal launch of our revised product set, we're really pleased with that. And obviously there's a couple of new investment options there, including a passive ethical indexed option, which we're proud to say is the first such product offered by a super fund in Australia. So yeah, continued work that we're doing both in the product space and also the fee space to hopefully give members the broadest choice possible.
Yeah, fantastic. Any other news that you've got to share?
Yeah, look, it's a really interesting time. Yeah, politically, superannuation. Obviously, there's a lot of press right now. There's work still following up from the Royal Commission vis-a-vis the regulator. APRA has been in the press a lot lately. Look, overall for us, our view is that these developments are positive. Look, anything that gives the regulator the space, the mandate and the resources they need to regulate effectively, we think is a good thing. And we're certainly continuing to work very closely with both APRA and ASIC and various other sort of regulatory bodies in terms of what we actually do. It's hard sometimes in the media, in the press, to just make sense of the politics behind super. As folks on the call may be aware, the coalition government, we have a new minister, Jane Hume, and she's been reasonably vocal in the media around a call out for areas of ongoing reform. And again, from our standpoint, we're very supportive of those things, but continuing to work closely with a number of industry representative bodies to hopefully assist those involved in those reform processes to make sort of well-informed decisions. But look, for us as a fund, we're growing quickly. We celebrate that. We've got strong performance across investment options and a number of initiatives underway in terms of just trying to streamline and improve the experience that our members are having overall. And maybe a final observation would just be the very significant increase in interest around responsible investing or ethical investing. Last week, in fact, the Responsible Investment Association of Australia released a new benchmark report, which really encouragingly just showed the significant growth in the responsible investment market size in Australia. Again, we're proud to be pioneering in that space, but equally pleased to see many other investors and also asset owners increasingly embracing an agenda around responsibility and responsible investment and ethical screening and so forth. And we continue to work closely with a number of other peer funds, regulators and other bodies in that regard.
Mm-hmm. Yeah, it's great to see that as a groundswell of individuals really wanting to ethically screen their investments. Really good. For those of you who have just joined us, I'm Gavin Martin from Cornerstone Wealth. I'll be facilitating the Centrelink and Age Pension webinar this evening. We have the privilege of having Ross Piper, the Chief Executive Officer of Christian Super, here with us, who has just done a little bit of an intro and an update on what's happening with Christian Super and the fund. Is there anything else you wanted to say, Ross, before we get into the main content of the session?
Look, I think, Gavin, I mean, obviously the folks on the call are aware of your background, obviously a person of faith, passionate about seeing seeing our members achieve their goals and fulfill their potential. And the advice and the inputs that you provide across our members Australia-wide is deeply valued and appreciated. As a fund, as I mentioned earlier, we are continuing to progress a number of initiatives which are all about ensuring our investment options, our fees and our whole way of operating is aligned with the values and beliefs that our members have. We deeply appreciate and value the engagement we have with our members, and sessions like this, I think, hopefully are valuable for members in terms of the sharing of information, but equally we deeply value any feedback participants can provide on sessions like this on how we can make them better, continue to ensure that they're relevant for our members. But yeah, thank you, Gavin, for being available tonight, and I'll hand over to you on that note.
Yeah, fantastic. Thanks again, Ross. Really appreciate you calling in. And feel free to chip in if you stay online for a little bit longer. But thanks again.
Great, we'll do.
Just a disclaimer to start off with tonight's advice is advice of a general nature. Please seek your own personal financial advice before making any decision. If you do wish to seek financial advice, the way that we assist you is we have you complete a questionnaire first. Then we meet with you for an initial consultation to understand your goals, what your current situation is, and look at the pros and cons of the range of options. Now, that meeting might be sufficient for you. It might be worthwhile going through to the next stage where we provide written advice to you in the form of a statement of advice. We can also help you implement that and provide ongoing advice as well. So tonight we're talking about Centrelink and the age pension. I thought a lot of your questions might have been driven by the change to the deeming rates, but just getting a bit of feedback prior to starting the session, it seems like it's the broader issues, not just the deeming rule changes that you're interested in. We will cover off deeming rules, but we'll also look at the basics of the age pension, when you qualify, how you qualify, claiming it, the income and assets test and how they interrelate, concession cards and travelling overseas as well. The first question is to how to provide for your retirement, and we've dealt with this. If you're thinking about retirement planning issues, there's 3 webinars that we've previously done. I'll send a link to those, but you can get them at cornerstonewealth.com.au/retire 2019. But the 3 broad sources of income in retirement are firstly your superannuation. So both your compulsory and voluntary contributions into superannuation, the government age pension, which is what we're going to focus on, the means tested age pension, and also your personal savings as well. But we're going to focus on, in this instance, on the age pension. In previous sessions we've discussed your superannuation and your own investments. So tonight's really all about the age pension and how it works and how you can utilise it to assist you. So what is age pension age? Well, it depends on your date of birth as to what age you were eligible for the age pension. It used to be different for men and women, but now it's changed to the point where they've brought them into a line, so men and women have the same age pension age based on your date of birth. So previously, depending on what your date of birth was, you had a different eligibility age for women and men. But now we're in this green zone here where, depending on your date of birth, this is your age pension age, going up to 67 years of age. So anyone born after 1st of January 1957, your age pension age will be 67. There was a policy prior to a coalition policy prior to the election to increase the age pension age right through to 70. So based on these age groups, or dates of birth, this would be your age pension age. But that policy was actually dropped as part of the election this year. So at the moment, as it stands, all we need to worry about is this green zone here, where your age pension age is a maximum of 67 years of age. I think it will end up going to 70, but it was just a point where it was difficult to bring that in such a challenging, election environment. So the first thing for eligibility is that you need to be of age pension age based on your date of birth. The other thing is that you need to be a resident of Australia. I had a couple of questions from people from the likes of New Zealand asking, I'm from New Zealand but I've been living in Australia, am I eligible? How it generally works is that you need to be a resident of Australia for at least 10 years to satisfy the residency requirement. And then during that 10 years, you need to have spent at least 5 years without a break to your residency. So I think that excludes short trips, but you can't have an extended time overseas without that full 5-year period in Australia. But there are international agreements, and that's probably the most important thing for our Kiwi friends, is that there is an international agreement so that if Kiwis come here, they can apply for the Australian age pension. What they often do is balance out any payments that you could be eligible for in New Zealand with that of Australia, but you just apply in the country that you're a resident of. Whether it's, if you're a resident of New Zealand, you apply there, and then that will trigger some requests from the New Zealand government to pay Australia. So there are international agreements. If you've got another country example that you're thinking of, then you can look at the Human Services website and see what the international agreement is and how it works. So you need to be you need to be of age pension age to be eligible. You need to be a resident of Australia to be eligible. So once you have hit your age pension age, you don't actually have to retire. You can keep on working, and depending on your incomes and assets, if you are still working and you still satisfy the criteria for the age pension, you may be partly eligible or fully eligible, depending on your income level. So you can keep working at age pension age. There's no requirement to stop working. You may choose to scale back your work or or work intermittently. I see this as a frequent and healthy way to transition from full-time employment to full-time retirement or non-paid work. So you can structure things how it works for you, and then you can cease work fully as well. So any of the spectrum there. But the important thing is that you don't need to retire at age pension age, but often people think about it at that point in time because they have the age pension to support them or partially support them into retirement. For those that do continue to work, there is a system called the work bonus. It's sometimes a bit difficult to explain how it works, but in principle what it means is that the first $300 you earn per fortnight from employment sources is not tested from an income test perspective. So we've got an example here of Margot she's at age pension age, but she earns $1,300 per fortnight. Because of the pension bonus, it reduces her assessable income from $1,300 down to $1,000 per fortnight. So that means under the income test, only 1,000 of the 1,300 will be tested, and the reduction rate is 50 cents in the dollar. So if she earns 500, if she earns 1,000 or is income tested for 1,000, then 500 of that will reduce the fortnightly pension. But the work bonus accumulates. So if you haven't worked for a period, the $300 per fortnight continues to accumulate, so that up to a maximum of $7,800. So Margot's, in this example, hasn't worked for 4 weeks or 2 fortnights, and each of those 2 fortnights she accumulated $300 of work bonus. So that accumulates to a $600 balance, and then she returns to work in the 3rd fortnight, and she earns $1,200. And so of the $1,200 of income, it's reduced by the current fortnight's $300 work bonus, and then it's reduced again by the $600 she's accrued over the previous 2 fortnights. So the only assessable amount of her $1,200 of income is the $300 over that amount. So if you actually didn't work for 12 months and then earned in 1 week or within the fortnight $7,800, it wouldn't affect your pension because you've built up that work bonus balance. It used to be $250 a fortnight, but from the 1st of July it's been increased to $300 per fortnight. And another initiative from the 1st of... before I go on to that, couples have an individual balance. So if you're both of age pension age, then you both have that work bonus balance that you can utilise to... And the whole purpose of it is to keep people who are of age pension age engaged in the workforce and encourage them to do so. And the way they do that is to allow some earned income to not affect your pension payments. But you have individual thresholds. And one other thing from the 1st of July is previously it was only employment income, so you had to actually have an employer to satisfy the work bonus requirements. But from the 1st of July this year, they've included business income or self-employment income as well. But you need to satisfy that income that you're generating needs to satisfy an active participation criteria, which means that you're doing work that involves effort and by effort, it means it's the opposite of income from passive involvement. So it's not investment income. It has to be self-employment, so you're actually doing work to get that income. But that's a change that will mean that those people that do sort of contract work or they just invoice for, they are able to access the work bonus this year, whereas they haven't been in the past. Now, so let's say that you've reached age pension age, you're an Australian resident, and so you're eligible to apply for the age pension. Now, if you're over certain thresholds, then you wouldn't actually apply, but it's important that even if you are working and you still may be eligible for a part pension, the way you go about claiming is you more and more human services are trying to encourage you to go online to apply. But you can call up and request to apply. And an important thing, if you have turned age pension age and you call up and apply for the pension over the phone, that triggers a claim. So that means that they should then either post you a form or get you set up online so you can complete it online. But if you get your forms back within the 14-day period, the lodgement period, your claim will be backdated to the point that you made the initial phone call. But you can either complete the claim by them sending you forms. They try to get you to go via online, but if you push back a bit, they will send you forms to complete rather than doing it online. Get the forms back and lodge them within 14 days of receiving them, and the claim will be backdated. It's important to note that if you don't have all the information at hand and the 14 days are coming due, you can do one of two things. You can give them a call and ask them to give you an extension, or you just post it in or forward it in or go into an office without all the information, and then they'll come back to you and ask for the information. But it means that you won't miss out on the claim being backdated to the date that you first claimed. So once you've completed the claim, there's one other thing. You need to provide proof of identity. Generally, we say go into a Centrelink office to do that. You can post in all your identity forms like your passport and other documents that you need to prove your identity. But generally, we say go in to an office, and therefore you can show them your documents and take them with you rather than them potentially getting lost in the post or in the systems of human services. So once you've done that, then most things can then be done online or via other communication, phone or fax or email, or their apps as well. And as I mentioned, don't delay returning the forms if you haven't got all the documents. Just get them in so that you can get the claim in process. Now, age pension payments, you've made the claim, you've been assessed as being eligible. Payments are made fortnightly in arrears, so each fortnight you are paid. The date that you were paid is determined on when your claim came through, but if that day that you're paid, day during the week that you're paid isn't suitable, you can just ask that to be changed, and the funds just go into your normal bank account. So you specify a bank that needs to be in your name or in joint names for the pay to be directed into. There is a facility called Centre Pay where you can actually directly pay other institutions via your payments as well, if that is of interest to you. So that's how it works. So how much can you get? That's a big question. The age pension is made up of a number of components. So we have the base pension, and so we've got 4 different scenarios. There's the single pension, a single person's pension amount, so the base pension. There's the couple's pension. This is each, and then this is the combined amount for a couple. And then if you're separated due to illness, then it's more like the single person's pension each that you will get because you're separated due to illness. But the base pension is $8.43 for a single per fortnight. And then there's a pension supplement. There's 2 different supplements that were introduced at different times. One's taxable, one's not. One's payable fortnightly, one's payable quarterly. But the total amount for a single is $68.50 per fortnight. And then there's an energy supplement as well. So for a single, it's $14.10. For a couple, it's $21.20 combined per fortnight. So in total, with a combination of all those things, per fortnight, the maximum pension a single can get is $926.20, and for a couple combined, it's $1,396.20, or $698.10 each. Now, on an annual basis, that is a $24,000 or $36,000 for a couple. And there are a couple of other items that I'd just like to refer you to as well. If you don't own your own home, or you aren't living in your own home and you're renting, then you may be eligible for rental assistance as well, so there's a payment there. And then if you live remotely, there's also another allowance that you may be eligible for also. So there's your sort of, there are other payments if you're caring for somebody and other things, but they're the main components of an age pension, or the top three are the main components, and then the additional ones that sometimes apply. Now the pension rate, so that's the maximum amount. So the maximum amount for a single 24, couple 36,000. That's the maximum amount. Now there's an income test that is applied. So they work out, well, based on the income test, what's the amount that you're eligible for, and then on an asset test, what's the amount that you're eligible for, and then the lower amount applies. So they apply both tests, and whatever the lower test is, that's what you're going to get. So that's how it works. And so for the income test for a single person, and I know a couple of you asked at the start of the session, I want to know how much pension I'm going to be eligible for and how much can I earn without it affecting my pension. For a single person, the maximum pension, you can receive the maximum pension, that $24,000 per annum, if your income annually is less than $4,500 per annum, or that's $174 per fortnight. It's assessed fortnightly. And then your pension reduces by 50 cents in the dollar for every dollar over and above that threshold, that fortnightly threshold, or you can apply it annually. And then there's so it cuts out altogether from an income test perspective. Once you earn over 2,026 per fortnight, that's 52,686 per annum. Earning over that much amount, or being deemed to earn over that much amount, and you come off the pension altogether. So if you're of pension age and you earn less, and you're single and you earn less than 52 grand, you're potentially eligible for a part pension, even though you're still working. Now, for a couple, the test is a little bit different. The way couples are assessed is that their assets are combined together, and then they're halved effectively. So you combined as a couple, your assessment. So the maximum rate, you'll get the full age pension if your income test is less than $8,008 per annum, or $308 per fortnight, and it's reduced by 25 cents for every dollar and above. It's effectively the same as a single reduction of 50 cents in the dollar. It's just a halving it between the two of you. And then your pension will cease if the combined income is over $80,610 per annum. So, if you're a couple, you're one or both of you are eligible for pension age, and you're earning less than 80 grand, then it's well worthwhile applying for the age pension. Now, the question is, what does income include? Well, it includes employment income and any income that you've salary sacrificed, but it is reduced by the work bonus that we explained earlier. That's why I explained it a bit up at the front there. It includes overseas income, it includes income streams and superannuation pensions, rent from real estate, farm and business income, and then the change that was just made is the calculation of deemed income. So deemed income, for Vicky, who asked the question, what on earth is deemed income? It is the income that you're assumed to have received on the financial investments that you hold. I'll go into that in a bit more detail. But that's what income includes. Deeming, here we go. So deeming works, so it's assumed income irrespective of the actual income that you've received. So it applies to all financial assets like cash, shares, bank accounts, investments, or loans to others. It doesn't apply to real estate assets. For real estate, they apply the actual income or rent less expenses that is being received. So how it works for a single person is that on the first $51,800 of financial assets you've got, cash, shares, bank accounts, etc., they'll assume that you're earning 1% on that. That was previously 1.75%. And then the remainder over and above, the financial assets over this threshold, they'll assume that it's earning 3%. It was previously 3.25. And for couples, the threshold's different. 86,200 is the threshold at which 1% deemed income applies, and then 3% over and above that, so previously 3.25%. So that's the rates that apply and the thresholds. Let's have a look at an example of how it might work. So Brian's a single person, and he has the following investments: a bank account that's got $5,000 in it and it's got no interest on it at all. It's just a transaction account. We've got a term deposit of $100,000 earning 3%, which is pretty good in today's climate. So $3,000 per annum. Shares of $50,000 earning with $2,000 of dividends. So total financial assets of $155,000 earning $5,000, which is $192 per fortnight. Now, if you remember from the previous slide, if you're a single person and you earn more than $174 per fortnight, then your pension will be reduced. So if he was assessed on his actual income that he's receiving, his pension would be reduced. But what Centrelink assume is that it's only 1% on the first 51,800 and then 3% on the amount over and above that. If you calculate that out, it's 3,600, which is below the 174 per fortnight. So in actual fact, even though he's earning more than the income test allows, he's only deemed on a lesser amount. And that can work both ways. If you're earning less than these rates, then you'd be negatively impacted by deeming. But in this case, Brian is positively impacted by the fact that they use 1 and 3% as their deeming rate, or the assumed amount of earnings on the account. Just had a quick question from Ross asking, can you confirm that the debt on an investment property is considered when calculating assets, thus lowering the value of the asset? Yeah, so it is the assets. So it's the net asset value. So if you've got an investment property worth $500,000 and you've got $200 of debt, the net value that they'll assess is the $300,000 difference. Thanks for the question there, Ross. Cam's just asked a question that they currently have too many assets to get an age pension, so you're over the thresholds. We'll get onto the age assets test later, but we'll go into a lot more detail in the next webinar about strategies that you can apply to maximise your income and assets test. So we haven't got time to go through that in this session, but the next webinar will go into all those sorts of strategies. So that's how deeming works. So it's calculating a return on your investment regardless of what actual return you're receiving on your account. So that's the income test. Now we look at the asset test, and the assets are things that you own, and as we mentioned with Ross, it's the net value that's assessed, so it offsets any lending. The only area where lending doesn't really impact is where you've got debt on your own home because it's an exempt asset. I'll go into that a little bit more shortly. So there are different thresholds of the assets test based on being a homeowner or a non-homeowner, and then the assets over and above the lower threshold are reduced by $3 for every $1,000 over the thresholds, which means that for every $1,000 over the threshold, you're losing $78 per annum in pension. When you look at it as a return, it's actually a 7.8% return. So there is a strategy that you can sometimes consider to gift assets. So you might gift 10 grand, and you could actually be better off than if you had the money earning 3% in the bank. We'll go into that. So what are assets? It's the net value of your assets. So as we mentioned with Ross, real estate net value, so value less any debt. It includes motor vehicles, boats, caravans, house and contents, farm, businesses, antiques, collectibles, anything that any items that you've gifted in the last 5 years. How to value the asset. So it's the net market value. With motor vehicles, we usually use Redbook, so redbook.com.au, and then we use there's different, I think I zoom in a bit here, yeah, so if you got a 2014 Toyota Camry, then the private sale price you could sell it for, potentially, on average, would be 17 to 19,000. We usually use the lower end of the trade-in price, so in this case 13,400 would be the value that we'd put on it. It's sort of fire sale type asset values, and similarly with contents, when you'll be asked a question on the application, what are the value of your contents. It's not the insured value, it's not the $100,000 or so that you might insure your contents for to replace them. It's the value that you would use to, if you put all your assets out on the street and had to sell them tomorrow, how much would you get for them? If you assume nothing, if you put nothing in there, Centrelink will assume $10,000. We normally say between $2,000 and $5,000 for your household contents. It includes your financial investments as well. Just got a couple of questions coming through. If we're currently I'm 4 years older than my wife. When I retire, my wife does not work. Could we get a couple pension? Yeah, if only one person is eligible, then you'll just get the one person's payment. So it's the couple's payment that I mentioned before. You both have to be eligible to get the full payment. So a couple might get, I think it was $36,000 from memory. So if you were one eligible couple, then you would only get $18,000, not the 36. You have to wait till the other younger spouses of age pension age to get the other $18,000, assuming you're fully eligible for the pension. What assets are excluded? So the principal home is excluded, and this is where up to a limit of 2 hectares around the property. So if you've got a larger property than the home, a larger property than 2 hectares around the home, then the other land is generally assessed as an asset. But there may be a rule if you've got a farm and you've lived on the farm for over 20 years, it might be exempt. But generally your home is exempt. And because your home is exempt, if you've got debt on your home, it doesn't actually reduce your assets. So often when people are of age pension age, we like to see their home mortgages paid right down. So if you've got a home that's worth $1 million and $500,000 of debt, and you've got $1 million of assets outside, you'll be assessed on the $1 million. But if you used $500,000 of the million outside your home to pay off the mortgage, then you'll be only assessed on $500,000. So it is good when you're of age pension age to pay off your home mortgage for that reason. Assets excluded from the asset test also include an accommodation bond or a RAD, funeral bonds, special disability trusts, which we often use for people with disabled children, and superannuation account balances. And this relates to the question that a number of you have asked, where one spouse is eligible for the age pension and one isn't. One of the strategies that we go into in a bit more detail in the next webinar is where the younger spouse holds a lot of assets in their superannuation fund, and they're excluded from the assets test. So effectively what the strategy is doing in brief is that you're moving assets into that younger spouse's name within superannuation, and then it becomes a non-assessed asset. It means that the person that is eligible for the age pension can often get the full age pension for the period up until the younger spouse turns age pension age. So that's a strategy that can apply. It doesn't work that well when the younger spouse continues working, but depending on how much they're earning, it can still be of value. Yeah, so this is the example I'm talking about. Paul's 67, his age pension age, but Jill is only 58. So all the superannuation assets in the accumulation phase in Jill's name is not assessed until she reaches age pension age. So what are the asset test thresholds? I think it was Cam, I think, might have mentioned that his assets are over the threshold, depending on if he's a couple or a single. If he's a single person and he's a homeowner, then he must have assets over 572,000 and therefore not eligible for any age pension. The couple threshold that you get no pension at is $860,000. So if you've got assets other than your family home over that threshold, you'll get no pension at all. Different threshold for if you're a non-homeowner, it goes up a bit higher. So for a single non-homeowner, the threshold is $782,500, and if you're a couple non-homeowner, then you can have assets, up to $1,070,000 and still receive a part age pension. The lower thresholds is where the full pension is payable, but as I'll try and explain later how the interaction between the income and assets test works, if these are all financial assets, then you actually won't get the full age pension because the income test kicks in. I'll try and explain that a little bit later, but it's based on the principle that you'll get paid the lower of the two, either the assets test or the income test. So just because you've got assets under the $263,000 as a single homeowner doesn't mean that you're going to get the full age pension if they're financial assets. I might just skip through that. So let's look at an example of how this sort of taper rate works. And the taper rate changed back in the 1st of Jan 2017. But Ralph's 68 years of age. He owns his home, which is worth $600,000. He's got 27 grand in the bank, 250 in his Christian pension account, 50 grand of shares, and he's got a car and some golf clubs and other things worth $20,000. His home is not assessed, so that's excluded from the assessment. So all his assets total the car and contents of 20 grand, 250 in his pension account, cash of 27, shares of 50, totaling $347,000. The lower asset test threshold from the previous page for a single person who owns their own home is $263,000, so he's got $83,750 over that threshold. So for every $1,000 over that threshold, his pension reduces by $3. So the pension will reduce by $251.25 per fortnight. If the maximum pension is $926.20 per fortnight, then he's going to receive $674.95 per fortnight. So the assets that he holds here are reducing his pension down to $674 per fortnight. So that's how it works for a single person. And then for a couple, it's very much the same principle, just different thresholds apply. So Sally and Sam, 68 and 72, both eligible for the pension, have an $800,000 house, 20 in cash, 600 in a Christian pension, 100 in shares, 20 in car and contents. The house is excluded. The other assets total $740,000. The lower threshold is $394,500, so the assets over that are $345,500, and that reduces the pension by $1,000 per fortnight. Maximum pension being $1,300, nearly $1,400. So Sally and Sam receive $359.70 per fortnight. To make up the difference of their income, they'll need to be drawing down on their Christian pension, their shares, and potentially their cash as well. So that's how they make up their income requirement. And as their assets reduce over time, then the pension can increase as well. So you slow down the eating into your assets if you are eating into your assets. So that's how the asset test works and the taper rate, how it applies. You could potentially do the calcs for your own situation. This slide is trying to explain how the interaction between the income and asset test works. And so again, we're focusing on individual circumstances. So a single homeowner, and this is where these thresholds have just changed. So the blue bar here, depending on if you look at your particular circumstances, the blue bar here is showing the amount of, and this is assuming that all your assets are financial assets, by the way, but it's assuming that if your financial assets are less than this value here, depending on your particular circumstances, then you get the full age pension. So a single person who owns their own home, if they have financial assets of less than $185,000, they'll get the full age pension. If they have financial assets between $185,000 and $281,000, they'll be income tested. So it'll be the income test that will reduce their pension. Over that $281,000, they'll be asset tested to the point that if their assets are over $572,000, they'll get no pension after that. So it's trying to show how the interaction between the income and assets test threshold works. But if you look at the asset test threshold for a couple homeowner, it says that if you have assets of, I think, 394, I can't quite remember the figure, but it said that if you have assets less than 300 and something, 394, you get the full age pension. But in actual fact, you won't, because you'll be income tested in that range between 324 and whatever the asset test threshold is. And so the deeming rate changes has had the biggest impact on those people that don't own their own home. So for a single, where's the single non-homeowner? So the single non-homeowner, if they have assets of about $542,000, then the deeming rate change that was announced last Monday would increase their annual pension by about $800. And for a couple non-homeowner, that deeming rate change would increase their pension by about $1,000. So it has limited benefit, but they say it's about 1 million people that would be impacted. A lot of those that are impacted will be pretty minor, and I think it's only 600 million over four forward periods, I think, over the forward estimate. So it's not massive in terms of how it's going to impact individuals' age pension rates. Just checking there's no other questions coming through. Oh, sorry, there has been questions coming through that I just didn't scroll down. Apologies. So Harold said, is earned income gross or net of tax income? So it's gross income is what you report. Did you say that if I gift something, say to my kids in the last 5 years, that will be treated as an asset when it comes to time of age pension? Yeah, I'll get onto that, James. David says, is super included in financial investments? Yes, David, super is included in financial assets unless it's in the accumulation phase of a person or who is under age pension age. Jennifer asks, what if I live in a section of your home and you rent out the other part through agency, also own this home with no debt? How is the asset tested? It's a tricky one. Yeah, they're really doing catch up with how that's assessed. It will generally be assessed as income if you're just renting it out to family members, then it's not asset tested. So it's not income tested, but if you're commercially renting it out, then it is income tested. And there's different rates. If it's just commercial, you're renting out a room and that's it, then it'll be fully assessable. If you're providing some board and lodging and food as well, then it can be up to 80% exempt, so you only get tested on 20% of it. So you really need to look into the rules there. Wendy asks, regarding assets, if the property is over 2 hectares, how is the proportionate value done? Can the house area total include the 2 hectares and the rest be valued at a lower rate being vacant land? Yeah, there is an assessment on what the value of that property would be. There used to be an Australian valuer's office that did it, but I think they're trying to get a bit more efficient, but they will place a value on it, relevant to it being just land value. Correct, Wendy. Greg asks, is an investment property an asset split 50-50 with a spouse with 9 years younger, so cannot apply for pension? You're assessed as a couple, so an asset that's owned jointly will be assessed as an asset together. It'll be included in your asset test there, Greg. And Margot asks, how do they assess a defined benefit pension? Is it only assessed under income, or is there some amount that is assessed as an asset? Generally, it's just the income that's assessed on a defined benefit pension if you've taken it as an income stream. Hope that answers your question. I think I've covered them off. Sorry I didn't answer them earlier. I didn't see, it wasn't scrolling down, so I didn't pick that up. keep them coming through and I'll respond to them. But that's how the interaction of the income and asset test works. Other things that you should be aware of, one of the large benefits of being eligible for the age pension is that there's the pension to concession card. There are benefits, for example, of discounts on healthcare, transport, household bills. I know in New South Wales, I think is quite good how you don't get charged registration, from my understanding, if you've got this pensioner card. So it could be worth between $1,000 and $3,000 depending on what your state benefits are. So there are discounts on utilities and that sort of thing, health, but there's also informal entitlements as well. If you've got a pensioner card, then you'll get, restaurants might have discounts, etc. as well. So that's well worth getting access to if you are eligible for the pension, even if you're only getting a very small pension. There also is the Commonwealth Seniors Health Card. So if you're of age pension age but not eligible for the age pension because of either assets or income, I think it was Cam might have been in that scenario. Sorry if I've mixed up names there. But if you're not eligible for the pension, you may be eligible for the Commonwealth Seniors Healthcare Card, and it doesn't have all the utilities and registration and rates type discounts, but it does have the pharmaceutical discounts, so the prescriptions, and it does come with an energy supplement. So for an annual payment of $366 for a single or $551 as a partnered couple, I think that's combined, not each. So there are some benefits of that. You just have to apply for it, and there are some thresholds. So the adjusted taxable income for a single needs to be under 54, nearly 55,000, just under 88 for a couple, or if you're a couple separated by illness, the threshold is $110,000. And that keeps indexing up each year from the time that it changed in 2014. So if you can't access the age pension, try and get the Commonwealth Seniors Health Card to get some discounts. There are also seniors cards that you can get if you just turn 60. A lot of states, or I think it's a state that issues them, that you can apply for as well. So that and that just gives you discounts for shops and other things as well. The way that income streams were assessed for Commonwealth Seniors Card changed in 1st of Jan 2015. If you have a pension account that started pre-then, the income won't be part of the, it's not deemed income, it's calculated based on a deductible amount, so you just need to be aware of that. It's a bit complex to explain, but if that's your scenario, just forward your application to Centrelink and see how you go. Gifts, we had a few questions about gifts, and I mentioned earlier that if you gift an asset, so if you've turned age pension age, you're 67, you've applied for the age pension, you're eligible. On the form, they ask you, have you gifted any assets or money in the last 5 years? So they'll go and so they'll ask you, over the last 5 years, have you gifted anything? If you've gifted assets over $10,000 per financial year, or $30,000 over 5 years in that 5-year period, then amounts over and above those figures will be considered an asset for a 5-year period from then. So you might have gifted $100,000 2 years ago to your kids to help them buy a home. $90,000 of that is going to be an asset for another 3. So that was 2 years ago, another 3 years. $90,000 of that is going to be assessed as an asset, even though you don't own that asset. So it's going to reduce your pension by close to $7,000 per annum because of that gifting. So be aware of that. What you've gifted 5 years earlier can affect your pension claim. On the flip side of that, I think the next slide, explains the benefit that if you are of age pension age and you've got 100,000 of assets and you're wanting to assist your kids or someone, you can gift them $10,000. That's the annual limit. It's the same limit for a single and for a couple, so $10,000 is the threshold. But if you gift an asset, that reduces, and you're asset tested, it doesn't work the same if you're income tested. So you need to make sure that you're asset tested. That is, your pension is being reduced due to your assets, not due to your income. gift the $10,000 and your pension will increase by $780 per annum, which, as I mentioned earlier, is about a 7.8% return. With that $10,000, you could actually be earning, if it was in the bank, for example, you might be lucky to get 3% interest or $300. So it can actually have a positive cash flow outcome by gifting that funds, and it can also benefit your child or whoever you're gifting the money to as well. Of course, you're not going to have the $10,000 to utilise, so you need to factor that in. But if you just do it on pure how much income it's going to generate, then it does, can have a benefit, and only to a certain extent as well, I guess. But if you were thinking about gifting assets to a child who was, want to help them get into housing, for example, do consider that 5 year prior to being eligible for the age pension rule. So if you gifted it 5 years prior to being eligible, then it won't have any impact on your age pension at all. It'll just be no longer be an asset of yours, and you won't be assessed on that at all. Factor that into your situation. I think this is close to the last topic, which is going overseas. So if you do travel overseas, if it's temporary, I'll start with temporary. They recently changed this limit to 6 weeks. So if you're overseas for longer than 6 weeks, then you'll still receive the age pension, but the pension supplement will be scaled back to the basic amount. So all that will mean on an annual basis is that the pension supplement will reduce from nearly $1,800 to $600. So it's only really a $1,200 difference annually that you'll get by staying overseas longer than 6 weeks. If it's only 8 weeks, it's a minimal amount that you're going to lose. For a couple, it's $2,700 down to $1,000. So it's again $1,700 per annum that you would miss out on being overseas temporarily. Now, if you are moving overseas permanently, then different rules apply. There's the portability rules kick in. So if that's the scenario, you're on the age pension and you decide to go and live overseas, then you need to satisfy the period of time in Australia rule. So it used to be 25 years, so prior to the 1st of July 2014, between the ages of, I think it's 16 and 65, you need to have lived in Australia for, it used to be 25 years, now it's 35 years, to live overseas and still receive the full age pension. If you've lived in Australia less than 35 years during that period of 16 to 65, or might be even going up to 67, if you've not satisfied that 35-year period living in Australia before you move permanently overseas, your pension will be scaled back pro rata. So if it's 17 and a half years that you've satisfied during that period of your life that you lived in Australia, then you get half of the age pension if you stayed overseas permanently or moved overseas permanently. That's how that works. There are other requirements that if you are overseas and you come, like you might be working, this often happens with missionaries, if you're working overseas and as a missionary and you turn age pension age and you come back to Australia to get access to the age pension, you can't then just go straight back again afterwards. You need to live in Australia for 2 years receiving the full age pension, and then you can go back and the portability rules apply. So there's a few tricky things with going overseas, but just got to work through with your particular scenario. If you want further resources, then there's the recording of the webinar will be at our website, so cornerstonewealth.com.au/retire 2019. The next webinar goes into a number of strategies like that older and younger spouse and how to maximise that, other income and asset type strategies that Cam, you might be able to apply as well. You can contact us via our website or phone number. Christian Super Help Desk is 1300 360 907, and then there's the website. So through the help desk, you can get the members help desk, people that will speak to you and give you factual information. There's also an online advice team that can give you some verbal advice and some specific advice around your superannuation as well. And there's also Super Equip. So if you log into your member online, then Super Equip has got some calculators that you can use as well, and it can generate an automatic sort of piece of advice for you too. So some good resources there. And then Centrelink, one key thing. So the older Australian line is 132300. You often got to wait half an hour to get through to somebody, but if you call that number, you'll be able to ask any questions. You can access the website, humanservices.gov.au. There's lots of information. All of what I've presented tonight would be on that website. And the key thing is avail yourselves, if you're not sure about stuff relating to Centrelink, of the Financial Information Services Officers. So these are like financial advisors within Centrelink that you can access for free. They're over the phone, or I think they do still meet people in person in offices as well. But it's well worthwhile discussing things with them. So they'll talk about the strategy of holding assets in the younger spouse's name in superannuation. So yeah, avail yourselves of those sorts of services. I've just had some questions come through, emailed through prior to the webinar. I'm just going to walk through those, but if you do have other questions, please feel free to answer them, and I'll address them as we go through. James has just thought of one, which was, I have 25% stake in my son's home. I paid the deposit and he is paying the mortgage. Would this mean that 25% of the house is part of my assets? Am I right? Correct. Based on what you're saying there, it would look to me that would be 25% of the value. If you own 25% of it, would be yours. Yeah, if assessed as an asset from a Centrelink perspective. Got James. If I want to gift $9,000 to each of my 4 children in 1 year, or each year for a couple of years, not sure. Well, you didn't finish the question. But if you did want to do it all, let's say it's $10,000 all in 1 year, that's 4 kids, 40 grand. You've gone over the threshold by $30,000, the annual, and so $30,000 would be an asset for 5 years. You can do things like consider it as a loan, so 30,000, you gift 10 and 30,000 is considered a loan, and then the next year you forgive 10 of the $30,000 loan, so then you've got 20 gifted, 20 loaned, and then the next year you do another 10 that's forgiven, and therefore 30,000 is gifted, and you leave the last 10 as a loan. So you can do those sorts of things to manage that, or you can do it 5 years prior to eligibility for the pension. Lorraine and Graham ask, is money given in offering a regular basis to church considered a gifting in the 5 years prior to the pension? Yeah, officially it is. Yeah, if you look at the Human Services website, they say, well, what does gifting include? And they actually specifically include your 10% tithe to the church. I struggle a little bit with this one, because if it was something else, if it was called a membership fee, then it would be it wouldn't be included in the gifting. But officially, the line is that tithing is considered a gift under the gifting rules. Thanks. James said, sorry about not finishing. Oh, no worries, James. Hopefully I answered your question about the gifting there, or fully answered it. No more questions coming through at the moment, so I'll just go through. I think there's about 4 of these questions. So this is from Johannes. I would like to ask the following question. I have recently moved from New Zealand to Australia. After 18 years living in New Zealand, I'm 60 years of age. Will I qualify for the Australian pension when I reach age 65? Based on your age, you're not likely to be eligible for the Australian pension until you're 67. I'm not sure if the New Zealand pension kicks in early, but if you returned to New Zealand and applied for the New Zealand pension, you might get it a little bit earlier if their pension age is lower than 67. But as I mentioned earlier in the session, there's a reciprocal arrangement with Australia and New Zealand, so you apply in whichever country you're in, and they almost sort out who should be paying you what. We've got a number of clients where they receive largely an Australian age pension, but because they lived in New Zealand for a time, the New Zealand government pays the Australian government a part amount, and that just reduces your Australian pension by the commensurate amount. The other question was, I'm planning to retire soon and will be living overseas for several years using my super funds. When I eventually return to Australia, I will need to claim the age pension. I realise that the rules could change in the meantime, but based on what the rules are now and any proposed changes to the wind, what forward planning can I do to make this a smooth process? I have no assets in Australia. If you've got superannuation assets, then I assume they're in Australia. As I mentioned earlier, if you're working overseas and return, I think the main thing is to plan to stay in Australia for 2 years to ensure that you can stay on the age pension if you do some further work overseas after the 2-year period. And question 2 is, what effect, if any, does holding a dual citizenship with another country where there is no pension scheme at all have on eligibility for the Australian age pension? I don't think that would impact the age pension. It's all about your residency requirements, so living in Australia for 10 years and at least 5 of those as a single chunk of those 10 years is the key. And then the portability rules, if you then moved overseas again permanently, would depend on how long you've spent in Australia for your working life. Next question from Norma. Is it best to combine my husband's super with mine or vice versa, or leave separate when he retires early next year? There's pros and cons of combining super or not. Firstly, you've got to be eligible to withdraw it, and ideally withdraw it without tax, and then you've got to have the eligibility to put it back in again. It's not just a simple matter of combining it into the one account. It's a process of withdrawal and then recontributing it to another spouse's account. You can save some fees, but it's minimal. I think the fees have just dropped on, as Ross mentioned earlier, the fees have just dropped to I think it's around $50. I can't remember the exact new figure, but it's an annual. The difference between having 2 accounts and 1 account is a matter of like $50, or it used to be $80 per annum. So it's not a massive saving by reducing it down to 1 account, but there are some benefits. The larger benefit is that more so around the strategy. If you can, if you're eligible for the pension and you can increase your pension by holding some assets in the younger spouse's super, that would be worthwhile. And then we will have about 240 combined. We want to take out about 12,000 a year. Is it best to do a pension stream or just withdraw that amount each year? Yeah, check out Norma, it's good to check out those retirement planning webinars, because it talks about the benefit of moving to pension phase, which is if you can move to an account-based pension, all the earnings are tax-free, all the drawings are tax-free, and if you are able to clear the taxable clear the components within the fund, the money could actually go to your kids tax-free as well. So I haven't got the slide here, but often we say that an ideal way to structure your finances into retirement are you own your own home outright, you've got an emergency fund of 3 to 12 months living expenses, and then the rest of your funds are in the pension phase of superannuation with tax-free components in there. That's generally what we try to target as advisors. And Denise was just asking about the differences in pension age, and I emailed her back, but just letting you know as well that if you've got spouses who are of a different age, so there's a significant difference in age, the strategy that I'll go into in a fair bit more detail in the webinar on the 5th of August. And I think that's it. So there's the further resources that you can go to, and I think I'm a minute over time, so apologies for going a bit late there. But let us know if there's any other questions. I'll stay online until I've answered your questions. There's a few that have come through. And it looks like, Ross, you're still online, so if you've got anything that you want to chip in, feel free to chip in as well.
No, really, really great session, Gavin. Lots of material and content there. I think maybe just check the Q&A list. There might have been a few late questions that came in, I think, from what I can see. Yeah,
I've just got a couple coming through now. So Heather, actually that didn't come through the question. Leanne is, if one partner is a pension age and the other is younger, can the younger spouse gift and it not affect the older person's pensions? No, it's considered as a couple. So the gifting is as a couple. So you can't gift via the younger spouse at all. Sorry about that, Leanne. Jennifer, do you know when age pension is ceased when a pensioner dies, or is there any death funeral payments? No, there's no death funeral payments. It basically ceases on the event of the death of the pensioner. James, thanks, very helpful. No worries at all. And then I think there was just the chat was another section. So I think I've covered it all off. Yeah. So thanks again. I didn't realise you're going to stay online all the time, Ross, but thanks for staying online. That was great.
Pleasure. It's been a great session. Thanks, Gavin.
Yeah, no worries. Thank you all for attending, and look forward to the August webinar if that's of interest to you. Good night.